1 year ago, I invested $10,000 into 2 ETFs. No stock picking, no day trading, no watching charts every morning. Just a simple system set up in about 30 minutes. Then, 6 weeks later, that $10,000 had dropped to $8,173. The market crashed. My portfolio was down $1,827. Every headline said it was going to get worse. I did nothing. By the end of the year, that same $10,000 had grown to $11,626. In this video, I'll show you exactly what I bought, what happened month by month, including the crash, and the free things I learned that changed how I think about money. Welcome to Capital OS, where we build financial systems that work while you sleep. I'm Paul Răduț, and on this channel we cover two things: smart investing and AI tools, because in 2025 those two combined are the most powerful wealth building stack a professional can have. If that sounds like something you want, subscribe. New systems every week. Now let's get into the numbers. Here's exactly how I split the $10,000. And I want to be transparent. You can verify every single number I mentioned today on Yahoo Finance. $7,000, 70%, went into VOO. VOO is Vanguard's S&P 500 ETF. When you buy VOO, you're buying a tiny piece of the 500 largest companies in America: Apple, Microsoft, Amazon, Google, all in one single purchase. On February 28, 2025, I paid $546.33 per share, which gave me 12.81 shares. Why 70%? Because the S&P 500 has returned an average of about 10% per year over the long term. It's the closest thing to a reliable engine of wealth that exists in public markets. $3,000, 30%, went into SCHD. SCHD is Schwab's US Dividend Equity ETF. It focuses on companies that consistently pay and grow their dividends. Coca-Cola, AbbVie, Verizon. On February 28, 2025, I paid $28.54 per share, which gave me 105 shares. Why add SCHD? Two reasons. First, income. SCHD pays you cash dividends every quarter just for holding it. Second, stability. Dividend-paying companies tend to hold up better during market downturns, which matters a lot when things get volatile. And in 2025, they got very volatile. The logic is simple. VOO gives you growth. SCHD gives you income and resilience. Together, they cover both sides of the equation. Total, $10,000. Setup time, 30 minutes. Now let's talk about what actually happened. And I want to warn you, this is not a straight line up. February-March 2025. Calm start. The portfolio moved sideways. VOO dipped slightly as markets processed uncertainty around trade policy. SCHD paid its first quarterly dividend, $27 deposited directly into my account. Nothing dramatic. This is normal. The market doesn't reward you on your timeline. Then came April 2025. On April 7th, VOO hit $442.80. That's a drop of over 19% from where I bought it. I was down $1,827 on paper. Every financial news channel was calling it a catastrophe. Tariff fears, recession talk, panic selling. My portfolio tracker was red every single day. I did not sell a single share. Why? Because I had a system, not a feeling. The system said, this is how markets work. The companies in VOO don't disappear because the price drops. You only lose money if you sell. Let me show you exactly what that looked like in dollar terms. My $7,000 in VOO was worth approximately $5,664. My $3,000 in SCHD had dropped to around $2,509. Total portfolio value, roughly $8,173. A paper loss of $1,827. That's what you're looking at on this chart. The exact moment most investors would have sold. I didn't. From May onwards, markets stabilized, then recovered, then rallied. Month by month, VOO climbed back through $500, $550, $600. SCHD kept paying dividends every quarter, $27, $27, $29, regardless of what the market was doing. On January 28, 2026, VOO hit $641.81, a new all-time high. The same ETF that crashed to $442 just 9 months earlier. February 28, 2026. Exactly 12 months after I started. Here are the final numbers. VOO bought at $546.33, ended at $631.04, up 15.50%. My $7,000 became $8,085, plus $91 in dividends received throughout the year. SCHD bought at $28.54, ended at $31.77, up 11.32%. My $3,000 became $3,340, plus $110 in dividends received throughout the year. Total price appreciation, $1,425. Total dividends received, $201. Grand total, $10,000 grew to $11,626. A profit of $1,626. A return of 16.26% in 12 months. Every number you see here is publicly verifiable. Prices on Yahoo Finance, dividends on Schwab Asset Management. For context, a typical high-yield savings account in 2025 gave you maybe 4 to 5%. This system returned 16.26% while I spent 0 hours actively managing it. Lesson number 1. The crash is part of the system, not a failure of it. In April 2025, my portfolio dropped $1,827 in a matter of weeks. If I had sold then, I would have locked in that loss permanently. Instead, I treated it as the system working exactly as designed. Markets go down, markets recover. The people who build wealth are the ones who understand this deeply enough that they don't act on fear. Lesson number 2. The most important investing decision you'll ever make is to do nothing. During the crash, I had one job: sit on my hands. No selling, no rotating into safer assets, no trying to time the bottom. Nothing. That inaction from April to October was the highest value financial move I made all year. Not a stock pick, not a clever strategy, just disciplined inaction. Lesson number 3. Dividends change how you feel about volatility. Here's something nobody tells you before you start investing. When the market crashed in April and my portfolio was down $1,827, SCHD still paid me $27 in dividends that quarter. The price was down, the income kept coming. That psychological shift from watching a number go red to receiving actual cash makes it dramatically easier to hold through a crash. Passive income isn't just a financial concept, it's an emotional anchor. So, $10,000 in on February 28, 2025. $11,626 out on February 28, 2026. A 16.26% return. Through one of the most volatile stretches the market has seen in years, a tariff-driven crash, a near bear market, a full recovery, and new all-time highs. The system worked. Not because I'm a genius, because the system didn't need a genius. It just needed someone who wouldn't panic. Is this guaranteed every year? No. Some years will be flat. Some will be negative. But over a 10, 20, 30-year horizon, this type of systematic approach has historically compounded wealth more reliably than almost anything else a professional can do with their money. The question isn't whether this works. The data answers that. The question is, when do you start? Next week, I'm breaking down exactly how to choose the right ETFs for your specific situation, your risk profile, your timeline, your goals. That's episode 2 of the ETF investing series here on Capital OS. Subscribe so you don't miss it. And drop a comment below. I want to know, were you invested during the April 2025 crash? Did you hold or did you sell? I read every single comment. Everything discussed in this video represents my personal experience and opinion only, not financial advice of any kind. Past performance does not guarantee future results. Always consult a qualified financial advisor before making any investment decisions. I'm Răduț. This is Capital OS. Build smarter.